Hello and welcome to Best Dividends Worldwide. Today, we're going to talk about 3 international high-yield dividend stocks with growth potential. Number 1 on our list is the Dutch Acomo. The dividend yield stands at 5.6%. We believe the dividend per share has plenty of growth potential in the long run. Here is why. But first, who is Acomo? What are they doing? Acomo is an international trading group headquartered in Rotterdam, the Netherlands. The company trades products for the food industry in 90 countries around the world. Through its subsidiaries, Acomo operates in 5 areas: spices and nuts, tea, edible seeds, food ingredients and organic ingredients. Typically, Acomo buys raw materials from producers, processes, stores and finally delivers them to food industry buyers. At 5.6%, the dividend yield is attractive. At this level it is in the sweet spot. It's way above any risk-free interest rate, but not too good to be true. It's calculated on a dividend per share that is no outlier, meaning it is at a sustainable level. Neither does it look attractive because of a massive price drop. There is no evidence that the current dividend yield is unsustainable. The company has never paid out more in dividends than earned in recent years. In the last 5 years, only 60% of the net profit has been paid out. In the same period, Acomo has generated about 118 million in free cash flow, and paid out about 110 million of it as dividends. These figures show that the company could afford its dividend payments, which is another positive indicator. In its latest annual report for the fiscal year 2022, Acomo confirmed its dividend policy. This policy implies that a substantial share of the annual net profit is paid out to the shareholders in cash every year. The payout ratio is subject to the realized, free available cash flow, and also depends on investment opportunities of the group. You can see exactly what this means for shareholders in the dividend history. Acomo is not a company that regularly increases its dividends. In difficult economic times, or when the company has to cope with a large acquisition, dividends are cut. You can see this in the period 2020 and 2021, where dividend payments were temporarily suspended. However, this was not due to structural problems, but rather because a larger company was acquired. The intention was to use the retained cash flow to reduce the accumulated debt as quickly as possible. For 2022, the usual payment pattern was resumed. The shares have underperformed somewhat, compared to their Dutch benchmark index, in recent years. But the difference is not worrying. It decreased significantly in recent months. Hence there is no evidence that Acomo has a major structural problem that will eventually result in permanently lower dividend payouts. Acomo shareholders must expect temporary dividend cuts. But in the longer term, it is likely that dividends will be increased on balance. Number 2 on our list is the German FREENET. Currently it pays a 7% dividend yield. We not only believe it is safe, but also that it has some growth potential. We'll show you why in a minute, but first, what is the company doing? The FREENET Group is the largest network-independent provider of mobile communication services in Germany. The company operates a nationwide network of around 600 stores. These mainly sell cell phone contracts from the 3 major network providers, Deutsche Telekom, O2, and Vodafone. The dividend yield of 7% is in the ideal range. Much higher than any risk-free interest rate, but not unrealistically high. The dividend per share is neither a one-time outlier, nor has the share price crashed. In other words, the dividend yield is not distorted. The dividend policy is to pay out 80% of free cash flow to shareholders in each year. This shows that management is shareholder-friendly. The guidelines of the dividend policy have always been met in recent years. FREENET has thus been able to afford its dividend payments. FREENET has been a reliable dividend payer for many years. In the medium term, the dividend has always been increased on balance. For fiscal 2019 though, the dividend was reduced to the statutory minimum. This was not done because the company had operational problems, but because several €100 million of debt had to be refinanced. Due to Corona, the direction of interest rates at the time was initially unclear. In this situation, the company did not want to risk any unnecessary capital outflows. The share price moves roughly in parallel with the benchmark index, the German DAX. This shows that market participants do not see any major problems that could eventually lead to a permanently lower dividend. For the 2023 financial year, management expects free cash flow in the range of €250 to €270 million. In the last financial year 2022, FREENET generated $250 million. This means that the dividend for 2023 should be at least at last year's level. FREENET offers a very attractive and safe dividend yield. Of course, temporary dividend reductions can never be excluded, but shareholders can expect a slightly growing dividend per share in the long run. Number 3 on today's list is the French AXA Group, one of the 3 biggest insurance companies in the world. With 149,000 employees across all 5 continents, and serving 95 million customers in 50 countries, AXA is a true global powerhouse. But today, we're here to talk about one specific aspect of AXA's appeal to investors: its dividends. The current dividend yield is 6%. We believe that the dividend payment is safe for the foreseeable future. Here are the reasons. AXA has a very strong dividend history, with 9 increases and no cuts in the last 10 years. This shows that the company has a functioning, profitable business model. There are currently no reasons to believe that this will change fundamentally in the near future. So, what's the secret behind AXA's consistent and growing dividends? For one thing, the company has a clear and shareholder-friendly dividend policy. AXA targets to pay aggregate dividends in a general range of 55 to 65% of underlying earnings per share. This means that the company is committed to returning a significant portion of its earnings to shareholders, while also retaining enough capital to fund growth initiatives and other strategic priorities. And looking at the company's payout ratio, we can see that AXA has consistently paid out around 60% of its earnings over the past 5 years. This indicates that the company can afford to maintain its dividend payments even during challenging times. But what about AXA's share price performance relative to its index, the CAC 40? In recent years, the share price has moved roughly parallel to its index. This is a further indication that there are no structural problems at the moment that could jeopardize the dividend payout. So, what does the future hold for AXA's dividends? While we can't predict the future with certainty, there are no indications today that a dividend cut is imminent. In fact, we expect that the dividend per share for 2023 will likely be at least unchanged, and that the long-term dividend will continue to increase on balance. Thank you for watching. The views expressed in this video are our personal opinions and should not be taken as guaranteed facts. It's important to carefully read the disclaimer before making any decisions based on the information presented.